Now we're going to do what we might think of as a vertical analysis type of system, in which case I want to see the percentages, but not comparing the change from one time period to another time period, but comparing items within one column that are totaling up to the total of that column. Therefore, we're going to choose the percent of the column. Where's the 4? Where's the 4? Therefore, I see it. I see the 4. Therefore, we're going to do a percent of a column. All right, so I'm going to click off of that and run it. Now, notice if I was in a modern view, switch to modern view, where is this located? It's going to be under the comparative items. And then if I go down to the calculations, it's under this percent of column, just so you know, and then we could refresh it here. And that's how it looks now. So we don't know which view they're going to be settling down on. We'll practice them both as we go. So I'm going to go back to the classic view here, and there's our basic classic vertical analysis type of situation. Now, what are we doing here on a vertical analysis? Let's do a little bit of an analysis of the vertical analysis. And that is that we're comparing everything to the total, remembering that for the balance sheet, we don't have a performance type of report. Our objective for our accounting is to generate revenue. On the balance sheet, what do we have on the total? We've got total assets equal total liabilities and equity. So therefore, it would make sense from a vertical analysis standpoint to compare each line item of the assets to the total assets, which are equivalent to the liabilities and equity. If we pull out the trusty calculator to see what that looks like, we could say the checking account, for example, or we could say the bank account's total comes out to the 2642.32 divided by the total for total assets, which is kind of like the bottom line, right? 23095.96. And that's going to give us about 11.44%. So that means that the checking account accounts for about 11.44%, 11% about of our total assets. Why might this be useful? Well, on the balance sheet side of things, we might want to compare to prior periods or other companies. If I'm comparing my landscaping business to, say, the benchmark or the biggest and best landscaping business, they might have more revenue, they might have more cash than we do, they might have more everything than we do, right? They just have bigger numbers. So how can we do the comparison? How can we benchmark? How can we try to copy what they're doing so that we can see that if we're at least as efficient as they are with the assets that we are using? We could say, well, look, how much cash do they hold on to compared to their total assets? We could say, for example, how much property, plant, and equipment do they have in comparison to their total assets, for example. So here's the PP&L, the truck. We have the 13,496 divided by the total 23,095.96. That gives us about 58%. Noting some industries are going to have a lot more, property, plants, and equipment, for example, versus other types of businesses. So for example, if we're just a YouTuber, we're just doing the gig work and whatnot, then we're probably not holding on to a lot of property, plants, and equipment. We've got the microphone, we've got, our computer, we've got some stuff there for sure, but for the most part, we don't need a whole lot. And that note means that there's not a big barrier to entry, and therefore you're going to have more competition typically. That's the way it basically works. Whereas other industries such as manufacturing or farming or something like that is going to take, or construction, that's going to take a huge initial investment to get the land, to get the equipment, and so on and so forth. And therefore there's going to be a constant struggle not only to have a lot of assets to try to generate your assets, but to have the liquid assets in order to pay off the current bills, meaning it's going to be quite possible for us to have a net assets that's quite high, assets minus liabilities, but still possibly not a lot of cash, because all of the assets that we have, all the cash is invested in property, plant, and equipment. On the plus side, however, with these big or capital investment intensive companies, you're not going to have as much competition because there's a huge barrier to entry, not imposed by the government per se, although you have that as well, and you can have the government kind of colluding. You could see big businesses actually colluding with the government to do things that look like they're going to be contrary to the business's interest when actually they are in alignment with the business's interest. Why? Because although it costs them more, it's a huge barrier to entry to everybody else, right? But that's the idea. So that's going to be kind of the trade-off, and we could look at a particular industry and see the pros and cons and try to compare on a percentage basis. Similarly with liabilities, we can compare our liabilities compared to the total liabilities and equity. So this gets into kind of like ratio analysis when we're thinking about the balance sheet. So for example, we might take our long-term liabilities, which are our loans, and say we have 25,000 there divided by the total liabilities and equity, which equals the assets, divided by the 23095.96, and we've got the long-term portion of the loan. Wait, this is total liabilities. Did I do that right? 20. Yeah, the long-term liabilities are greater than our total liabilities and equity, which is interesting. We could also compare total equity, which is actually a negative number here, right? So now we have a negative number in the equity. So that's going to get into some kind of like ratio analysis, but remember that the liabilities and the equity represents how we're financing the assets. Where are the assets that we have coming from? How are they being financed? Either we, the owner, are putting money into the company that we then use to purchase the assets in order to help to generate us revenue, or we took out a loan to get that initial investment, and or as the company is proceeding forward, we will hopefully be generating revenue, and the revenue will be retained earnings, rolling into retained earnings, helping us to hopefully finance the business. Now, obviously, there is no retained earnings right now because the only data in the current system is for 2024. Therefore, we have a limited amount of net income and a negative amount for the opening balance. So we haven't like recovered the amount of the initial investment that basically went in would be kind of the idea here. But that's the general idea.